Well, it does appear that the minutes of Jay Powell's last meeting as Fed chair show that members were more concerned about the possibility of a rate increase down the road than perhaps the markets were thinking. High energy prices contributing to inflation because of the Iran war, amid concerns the war could drag on long enough that inflation expectations become unmoored. While participants generally expected that tariff-driven inflation would ease during the course of the year, some noted tariffs could be increased, leading to additional upward pressure on prices. And given all that, almost all participants noted there was a risk that the conflict in the Middle East could persist for an extended period, or that even after the conflict ended, the prices of oil and other commodities could remain elevated for longer than expected. The vast majority noted inflation could take longer to return to target than they had previously expected. A majority of participants highlighted, the minutes say, that some policy firming would likely become appropriate if inflation were to continually run above the 2% target. To address this possibility, they continue, many participants indicated that they would have preferred removing the language from the post-meeting statement that suggested an easing bias. And remember, it was a 9-3 vote to remove that bias, but apparently a number of additional participants who weren't voters agreed with the three who wanted to take it out. Overall, the economy was performing well. The minutes say the labor market appeared stable, although uncertainty about the future outlook for the economy might have been holding down hiring. There was also an extended discussion of financial stability, with participants concerned about the possibility of losses in private credit that might lead to a broad credit contraction. A few worried about hedge fund participation in the Treasury market, noting that unwinding of leverage positions by those institutions could generate broader financial market pressures. And many mentioned concerns about cybersecurity. Tim and Emily?
My ears perked up when you said private credit. I mean, how unusual is it to see the central bank opining on a specific asset class in these minutes? And do we have, I know you're just reading them right now, but do we have any more insights into more risks that they flagged on that sector?
We don't really have any more. It doesn't go into great detail about it. But remember, private credit's been in the news a lot, and there have been some funds that halted redemptions. And so there are questions about what that would mean. And so apparently members decided that they were going to discuss it, and they did express some concerns, perhaps more than we've normally heard, certainly from participants in the private credit space who say it's not a risk. Fed officials see that there perhaps could be something out there.
Hey, Mike, on the war, that got me thinking about what the Fed actually can do when it comes to a higher inflationary environment as a result of higher oil prices. It's not like the Fed can bring down oil prices. They can only tamp down demand. What does an extended period actually mean in Federal Reserve speak, and how it could affect rate policy?
Well, they don't specify, but it probably means months. And they're talking about more than just high energy prices. They're talking about high energy prices feeding into other parts of the economy and parts of the economy that perhaps use petroleum to make products or to deliver products, and that would push inflation expectations higher as a broader price increase started to affect Americans. And that's what they're particularly concerned about. And what they did seem worried about is that this conflict could, and so far has, lasted a lot longer than the administration suggested it would. And so as long as that continues, that increases the risk of the inflation expectations problem.